Hi everybody, my name is Griffin Bridgers. Today we're going to talk about a recent private letter ruling, PLR 2022-48006, which dealt with an extension of time to make an allocation of a GST exemption, but there are some lessons embedded in this around the potential for a late allocation of GST exemption and some of the steps you might need to take to fix that error if it is later discovered. Now, before we get started, I want to remind you this presentation is not intended to substitute for legal or tax advice and is provided for educational purposes only. So, quick lay of the land before we get started. Anytime you make a gift to an individual, whether it's outright or in trust, you typically have to file a gift tax return, especially if the gift exceeds your gift tax annual exclusions that might be available for that gift. Now, a good reason to file a gift tax return, regardless of whether or not one is actually required, is the allocation of GST exemption. Now, one issue out there that we often see, and this is important because we've recently gone through a flurry of a number of gifts that have been made to irrevocable completed gift trusts, which are typically the types of trusts where you see the need for a gift tax return pop up. But attorneys don't always necessarily prepare tax returns, and it may be the case that some attorneys who prepare irrevocable completed gift trusts and help their clients to fund those might take a hands-off approach and say they're not going to prepare the gift tax return. Now, whether that's actually communicated to the client is another question, but at the very least, the attorney should be counseling the client to say, look, you need to prepare a gift tax return, see your tax preparer to get this done if the attorney personally is not going to do it. But if there's that gap in follow-up, that can be a bad outcome, not just from a gift or estate tax approach, but also from a generation skipping transfer tax approach, which I'll refer to as the GST tax in this presentation. So the recent PLR I illustrated, or highlighted, illustrates these headaches that can pop up where there is a late or missing gift tax return. Now, quick facts is that there was a certain year in the past where it looked like two trusts were set up by two spouses in the same year. One spouse created and funded a slat with gifts, and the other spouse created and funded an irrevocable descendants trusts and made gifts to that trust. So both trusts were funded in the same year and created in the same year, but the catch is that the attorney who prepared the trusts failed to advise the clients of the need to file gift tax returns. And then later, the decedent died and it was discovered that the gift tax returns were not filed. So recall, in this case, it was the decedent who had created the slat. The surviving spouse was the one who had funded the descendants trusts. And the surviving spouse, sought after the fact, after this error was discovered, an extension of time to file a gift tax return to allocate the spouse's GST exemption. And luckily, that extension of time was granted by the IRS. Now, embedded in this are some lessons and questions that we're going to look at, which will kind of help you to get a better lay of the land on the allocation of GST exemption. Now, a big question is whether the spouse could have filed a late gift tax return here. The answer is yeah, probably, and there may not have been any penalties if no gift tax was owed. But we want to keep in mind that a primary goal of gifting is to freeze the value of gifted property for both estate and GST tax purposes. The way you do this is when you file that gift tax return, it reports a claimed value to the IRS that might be discounted for non-cash assets, and there's a certain limitations period of 3 to 6 years depending on certain factors that starts a clock ticking where after those years have passed, the IRS is constrained in challenging the gift tax value. So it's usually a good idea to file a gift tax return for that value freeze proposition. Now, if you never get around to it, if you want to do a late gift tax return, you certainly could, and you could get the same freeze for gift tax purposes. But for GST tax purposes, you cannot. Code Section 2642B3 says that if no gift tax return is timely filed, and if there's no deemed allocation of GST exemption, then the trade-off of a late return is that you have to allocate GST exemption based on the value of trust assets as of the date the allocation is filed. So that's the great irony here, is that you could technically file a late gift tax return and use values relating back to the date that the gift was completed. But for GST tax purposes, you don't get that same benefit. A late GST allocation is going to use the value of assets as of the date of allocation. So by missing this deadline here, the issue was that the attorney potentially lost for the client the ability to use this value freeze for GST tax purposes. So the significance of the extension that was requested and granted here is that by treating this as an extension of time to make the GST exemption allocation, that allocation could relate back to the date of the original gift at a lower value, presumably, and not use the value as of the date the allocation is filed under Code Section 2642B3. Now, you'll note that I italicized here another exception that says where there is no deemed allocation of GST exemption. So, as I was reading through this, you may have picked this up too. The big question is, why was there no deemed allocation here? And the key lesson here is to keep in mind that you don't always get deemed or automatic allocation for transfers to trusts. Now, Code Section 2632 and its associated Treasury regulations under 26.2632-1 contain fairly generous rules that allow for the automatic or deemed allocation or use of GST exemption for lifetime gifts. Now, there are two important qualifiers, especially in the trust arena, that you have to keep in mind. And this is going to apply when there's not a direct skip, typically, but for both rules, but it could also apply in the case of a direct skip as well for one of them. I'll look more at the indirect skip angle here, which if you want to know more about, go back and look at my series on the basics of GST tax itself, and that'll give you some insight. But either way, two important qualifiers here is that one, deemed allocation only applies to gifts that were made after December 31 of 2000. Two, the deemed allocation only applies to gifts to a GST trust. So the big issue here is that if you can't check both boxes, there's not going to be automatic or deemed allocation of GST exemption. And the trade-off is that you have to file a gift tax return to allocate GST exemption based on the gift tax values. Now, just filing a gift tax return isn't enough. If you don't meet both these requirements, the gift tax return has to include the Schedule D where you actually allocate GST exemption. One issue I see a lot of tax preparers run into is that they don't actually fill out the portion of the return that deals with the allocation of GST exemption. So you have to do that. You have to make sure that gets done. Now, as I mentioned, the big issue looming in the background here is timing and the effect of that timing on the ability to freeze the value of an asset for GST tax purposes. You could do so with a late gift tax return, but you can't do so for GST purposes if you don't have deemed allocation. So while you have until the due date of the transferor's estate tax return, which could come well in the future, you have until then to allocate GST exemption, and if you don't, it gets automatically allocated at date of death, even to transfers that occurred before December 31 of 2000, but the difference will be the value as of the date of that deemed allocation. So big lesson is if you want to get that value freeze, you have to make sure that you either qualify for deemed allocation or timely file a gift tax return to allocate GST exemption. Now, if you can't check both boxes, obviously if you're making a gift now, you're making a gift after December 31 of 2000, so you're going to meet that. But even if you have a trust that doesn't qualify as a GST trust under Code Section 2632C2 Cap B, you can still allocate GST exemption on a gift tax return by electing to treat the trust as a GST trust if you want to qualify for those deemed or automatic allocations in the future. So if you don't want to have to do this repeated exercise of filing gift tax returns, there are ways you can make this automatic from that point forward to deem the second requirement over here, a gift to a GST trust, to have been met. Now, if you're going to rely on automatic or deemed allocation, it's a good idea to keep good records on the trust level of what gifts have been made to the trust and how much GST exemption may have been automatically or manually allocated to those gifts. And there's some exceptions in there that are covered also in my series on the basics of GST tax. But the big lesson, the key takeaway here that you want to avoid is that with a late allocation of GST exemption, you may lose the benefit of a value freeze and or discounts that could have been claimed had you made a timely allocation of GST exemption on a timely filed gift tax return or through the use of the deemed allocation rules if you do indeed qualify for deemed allocations. As always, if you have questions or topic suggestions, you can email those to me at griffin.bridgers@gmail.com with the caveat that I cannot give tax or legal advice in response to your questions. But I thank you again for listening to this video, and I look forward to seeing you in my future content.